Today, we're going to talk about currencies and government debt. And yeah, I know some of you are just like, but trust me, this one's going to be a good one. Now, the U.S. Federal Reserve is in the process of raising interest rates. The idea is that by raising the cost of borrowing, raising the cost of money, that there's going to be less consumption. And that's how ultimately you get inflation under control. The U.S. is dealing with its highest inflation rates in 40 years. We're seeing it in raw commodities, we're seeing it in energy, we're seeing it in housing, we're seeing it in baby formula. And until we find a balance between supply and demand, this is going to be our normal. Interest rates are the tool that the Federal Reserve has. But it's not just the Federal Reserve in play here. There are other major countries dealing with similar issues. The problem for them is they can't raise interest rates. If you look at Europe or if you look at Japan, these are economies whose demographics have aged so fast that all of them have more people in their 50s than their 40s and their 30s and their 20s. And since economies with a lot of people in their 20s and 30s are where most consumption comes from, these countries are probably never going to have positive interest rates again. Europe's already been at 0 for the last decade, Japan for roughly 2. They cannot emerge from this. If you look at the other major players, say Sweden or Denmark or the British pound, it's not quite as bad. They do have better demographics, but Sweden and Denmark joined with the Brits and the Europeans in supporting sanctions on the Russian system, and they're kind of at ground zero for feeling the economic effects. So while they are experiencing inflation that is uncomfortable, they feel they don't dare raise interest rates for the risk of choking off whatever economic growth they might be able to have in an environment where we have shortages of everything because of the Russians. In case of the British pound, it's even worse because the Brits still don't have a plan for what happens after Brexit. So anyone who wants to invest in Britain just has a huge amount of uncertainty. The only other country of note is China, but the yuan is not internationally traded, because the economic system there is now so stilted and because of lockdowns so shut down that if they were to open their economy to the wider world, you'd have a huge amount of capital flight. They can't tolerate that. So only about 1% of the circulation of the Chinese yuan is actually available for international exchange, and most of that is in Hong Kong. Yet on top of that, the Chinese tend to print currency at 2 to 5 times the rate of the United States, and they're monetizing their entire system in a way that the United States has never even considered. Now, where does this take us? Well, a lot of the world's economies, the krona in Denmark, the Swedish krona, the European euro, the British pound, the Japanese yen, the Korean won, the Australian kiwi dollars, they're all de facto linked to the United States' system now because of the sanctions that are going on in Europe. That means that we have a country that has all the demographic strength, the United States, and a country that has the global currency, the United States, and a currency that everyone else is taking their cues from, the United States. That suggests that the US dollar has nowhere to go but up for years to come. And on top of that, we have a bond issue. Now, because all of these countries around the world can't raise interest rates, when they issue debt to get people to buy it so they can fund their government, they have to offer terms that are around 0. In fact, we've got $2.5 trillion of international debt, government debt, that is actually earning negative returns compared to the United States. The United States is the beginning of a very long series of interest rate increases in order to get inflation under control, but no one else is. That means the differential between American bond yields and global ones is just going to rise and rise and rise and rise. And that means we're going to see huge volumes of foreign capital flooding from the sovereign debt markets of the rest of the world into the United States. Because would you rather have like a negative 1% return or a 3% return? That suggests that the United States is going to be able to borrow at lower prices for a longer period of time than anyone has factored in. And as long as the US economy remains consumer driven with its relatively healthy demography, that is going to be for decades to come. Bottom line, even now, in a period of inflation, probably at the turning of the business cycle, where the baby boomers are moving to retirement and taking their money and consumption with them, the US still looks pretty good, in part because it's doing what Ross Perot so eloquently put, that giant sucking sound, pulling the money out of the rest of the world. Okay, that's it from me. If you want to hear more about this topic or other topics related to capital inflation, we are hosting a seminar this June 8 at 1 p.m. Mountain Time. Feel free to sign up. The button's right below. If not, items on this mailing list, whether it's newsletters or videos, will continue to be free. They will always be free, and we would appreciate donations to the AFIA Foundation, which is an NGO charity that is providing medical assistance to the refugees caused by the Ukraine war. The link for that is below as well. United States, we are a partial difference. The baby boomers are the generation that matters the most. They're the largest generation we've ever had, and they are doing what everyone at their age group does. They are retiring. So we're losing our single largest worker cadre. At the same time, we're using our single largest skill cadre. I don't want to try to talk you out of being concerned about inflation. And monetary inflation is an issue. War disruptions are an issue. Supply chain disruptions are an issue. That's all true. But they all combined pale compared to what's happening in the American labor market right now, because the boomers are leaving and they are never coming back. Now, the next, we don't need to talk about, well, let's talk about finance real quick. It's relevant. As you age, your income increases. As you age, your spending decreases, which means your net capital position gets better. The amount of money that you can invest and save for retirement increases, and it peaks the decade before you retire. So this is just showing what total average net worth in the United States is. And then it starts to fall off. If anything, it falls off faster than this would suggest, because after 65, mortality really kicks in, and you have a lot of couples that lose one, and all the assets transfer over. This keeps that in data. That's relevant to this. Now, what this means is if you want to do anything, and that doesn't matter what it is, build an aircraft carrier, build a road, buy a car, the capital environment we're in right now is perfect because the baby boomers are at their capital peak. But a year from now, the majority of the baby boomers will be retired. So instead of having deep, liquid, available pools of capital, everything's going to become a lot more expensive as the capital environment just shrivels up. So we saw the absolute cheapest mortgage rates that we have ever had in history last year. You were able to get a mortgage for under 3%, which is just stupid. We're already seeing that unwind. And at this time next year, it's probably going to be something closer to double. Part of that is interest rates in the Federal Reserve, not absolutely true, but most of it has to do with overall capital availability, and that's demographic. And those numbers are in the process of turning right now. There is a partial exception. The gray and the yellow is the same data from before. That's average. The blue and the orange is what it looks like if you factor out the top 1%. Now, in the United States, about half of all financial assets are controlled by the top 1%. And if you retire with $50 million, you know you're not going to need all of that. So the issue becomes, what does that do to capital costs? Well, in the United States, that 1%, half of all financial assets, they're probably going to leave about half of their assets, so 1/4 of the total, economically engaged in the stock market and the bond market, because they know they don't need it all. And they're also going to start transferring funds to the next generation or to charities. So that takes some of the sting out of a financial system. But this only works in places that have deep pools of liquidity, large financial markets, and screaming inequality. And there's only two places like that in the world, the United States and Luxembourg. Everyone else is going to be looking at capital costs at least increasing by a factor of 6 or 7. In the United States, it's probably only going to be 3 or 4. Now, the Americans have had help, but let me say it again. The American baby boomers have had help with, hang on for just a second. Someone's knocking on my door. I'll be right back. Sorry about that. Apparently, I put up the needed service sign instead of the do not disturb sign. That has been addressed. Okay, so when the baby boomers entered the market, there were so many of them that they pushed down the cost of labor relative to other systems and in compared to American history as well. At the same time, we had a big Mexican wave that started in the 1960s that never really let up. And so we had baby boomers, a large generation, and Mexicans, an inexpensive workforce, moving into the American labor market at the same time, and that held until now. And that means that the United States has the lowest cost of labor and some of the highest productivity per unit of labor in the entire world, certainly of the advanced world. But the baby boomers are now retiring, and check this out. 25 years, Mexico started belatedly to industrialize. They had the tequila crisis. They decided they needed to shift gears. They went into manufacturing. People started moving off the farms and into the cities. And so we saw their birth rate halve. Now, Mexicans are not vanishing from the world, but it does mean that they have become a limited resource. And net migration from Mexico to the United States has now been negative for 12 of the last 13 years. It'll probably never be positive again. And so we are looking at a quantum shift in labor. You guys are certainly going to feel that in recruitment. Here's Central America. Same process, started 5 to 10 years later. So this idea of migrant caravans coming across the border, we're in the last couple of years of that happening because the Central Americans are just running out of young people. Okay, next generation down from the boomers. This is Gen X, this is me. I'm part of what was until recently the smallest generation in American history. And when we look at the baby boomers, we don't like what we see from any number of measures. But from a labor point of view, we didn't like the fact that they valued their money over their time. So there were a lot of boomers, they pushed down the cost of labor. So a lot of boomer families felt that the only way they could make ends meet is for the second spouse to enter the workforce. That pushed down the cost of labor even more and put a lot of financial strain on boomer households. That's one of the reasons why the boomers have the highest divorce rate in American history. Gen X looked at this, we're like, we want no part of that, excuse me. COVID. So we are far more likely to be single income households. And if that means an economic hit, that means an economic hit. Our time is at least as important to us as our money. That's worked against us for our entire professional lives. We are the generation of being an intern endlessly. But now, with the boomers vacating all of those upper positions at the same time, we're stepping into a space where we couldn't possibly fill all the shoes. The boomers were a large generation with a high labor participation rate, while Gen X is a smaller generation with a lower labor participation rate. Now, this is great for Gen X right now. We're seeing labor price appreciation for the first time in our lives, and it's brilliant. But for everyone else, it's a bit of a disaster because we know that among skilled labor in particular, we have at least another 10 years of labor inflation ahead of us, probably closer to 15. The generation at the bottom, these are the Zoomers, these are Gen X's kids. And they are not millennials. Millennials are collegiate, they're cooperative, they're good at the touchy-feely skills, they're good at management. Zoomers are good at none of those things. Zoomers were raised by Gen X, and we told them very directly, Medicare and Medicaid and Social Security, they're not going to be there for me, so they're certainly not going to be there for you. You will always be outvoted by the millennials, just like we were always outvoted by the boomers. You'll probably never have a president, just like we will never have a president. If you want to get ahead, you have to literally be ahead, and not just of your class, of everyone. They're antisocial, they have the highest suicide rate in the country, and their dream job is to be in a locked closet in the dark coding. The worst thing that has happened to the Zoomers so far isn't COVID. They loved COVID because they had an excuse to never see other people. The worst thing that's happened to them is an end to COVID because now they actually have to interface with people, and it's not something that most of them are comfortable with. This is the future of the labor force. This is the future of your recruitment because they're all already here. They've all already been born. We know exactly what the labor force for the next 20 years is going to look like. And then finally, we've got the millennials. There are two groups of millennials. The first group match the negative stereotypes: lazy, entitled, mom drives them to work, still live in the basement, all that good stuff. The second group has always done everything that we have always expected of them. They graduated from college a semester early. They didn't go on a walkabout. They went right into the workforce. And because of that, they got screwed. The good millennials, if you will, when the financial crisis hit, they were the last ones to join companies, so they were the first ones shown the door when the mass firing started. So whether it's because they went to Europe for 5 years to find themselves, or because they did everything right and just got fired because of circumstance, today's millennials have missed out on 3 to 5 years of formative work experience in their 20s, and they will never get that back. Which means that they'll always be behind until the day they retire. The hope for the labor force, the only chance we have of getting back to where we were in 2019, isn't with the millennials directly. It's with the millennials' kids. We have to wait for them to grow up, get trained, and enter the workforce. And that doesn't happen en masse until 2045. So the environment that we're dealing with economically in the United States and what your recruitment pictures look like are pretty stark, but they're also already known. These trends are already in play. No more millennials are ever going to be born. Their oldest ones are already in their 40s. No more Zoomers are going to be born. So we know exactly what the demographic looks like for at least the next 25 years. And it's just something we have to learn to work with. Much worse in China. Oh my God, so
Can I go
bad.
back and ask a question?
Yeah, of course.
So what are the millennials going to have to do with their children to be this amazing population of our hope? What is your recommendation there?
Yeah, I mean, these people, for the most part, have not been born yet, so we don't know exactly what that's going to look like. As a rule, you do things differently than your parents did when it comes to raising kids. So I am not worried about the next generation, whatever we call it, of acting like the millennials. That's going to be something different. It would probably, just historically speaking, be something a lot more similar to Gen X. But the snowflake thing has virtually gone away, thank God. It was never as big as we thought it was. It was more for those millennials who were kind of stuck on themselves as opposed to the ones that actually show up to work. I can't give a recommendation because everything about how we educate now is changing so rapidly. Things like Khan Academy are providing options that just didn't exist 10 and 15 years ago. I'm literally punting on that question. I don't know. Sorry.
No problem. I'm selfishly asking because I'm in that category and I have kids.
I hear you. Well, I can't speak to how you were raised, but I can tell you that the more people are willing to be around people certainly helps.